Welcome to our Financial Literacy Education series. My name is Corin Jacker. I'm from Priority One Wealth Management Group. During this series, we're going to cover a range of topics to help you better understand your money, to help you become more engaged with your money and your finances, and to help you make better decisions about your money. In today's episode, we're going to be looking at the concepts around creating wealth. If you haven't already looked at our previous episode on cash flow and budgeting, I suggest you do that. And the reason is, to look at wealth creation concepts, one of the first things we need to do is establish a surplus amount of income that we can put aside towards savings and investment. So that's why it's really important to understand your cash flow, the money coming in versus the money going out, and your budget. So you can identify that surplus level of income that you can put towards wealth creation. Essentially, there are four broad concepts of wealth creation: investing in your own name, debt reduction, superannuation, and gearing. There are many subtopics of these broad concepts, but these are the four broad concepts you need to consider when deciding what to do with the money that you can put towards wealth creation. In today's episode, we're going to just focus on saving in your own name and debt reduction. And I want to do that because you can compare the two relatively easily. Let's start with saving in your own name. So saving your own name at its most basic level is money in the bank account. So savings accounts could be even term deposits. You could get more advanced and perhaps put money into a managed fund or managed investment or an investment bond in your own name. Or you could look at direct investments like shares or exchange traded funds on the share market. The main advantage of having money saved in your own name is around access. You can usually get access to your funds relatively quickly and easily. The main disadvantage can be around tax. Particularly if you're working and you're starting to push yourself into those higher marginal tax brackets, then it becomes very tax ineffective for us to have money in our own name. But we do need some amount of capital in our own name for access to funds when we need it. But how does it compare to the other options? Let's look at debt reduction versus savings in our own name. So, just going back to that cash flow and budgeting episode, if we've identified that we've got $1 worth of surplus cash flow that we can put towards something, and if I've got a loan, so in this case, I'm going to look at an example where we've got a mortgage. So I can put that extra dollar off my mortgage, or I can invest it somewhere else. So in this example, I've got a savings account and I'm earning 1%. And in this environment, that's actually pretty attractive for a savings account. I'm on the average wage, so I'm probably on a marginal tax rate of around 32.5% at the moment. And I'm comparing that to my loan, which at the moment might be around 3%. So, if I've got $1,000 worth of earnings and I earn 1%, that's pre-tax money. So I'm going to lose, in this case, 32.5% tax. So my net interest that I've earned is 0.675%. Let's see what happens when we look at what's going on with our home loan. So if we've got a home loan and it's at 3% interest rate, and if it is our home loan, it's not tax deductible. So we're having to earn money, pay tax, then pay off the loan with our after-tax dollars. So what we need to do when we're comparing it to something else is we need to convert our home loan interest rate into a pre-tax equivalent. So in this case, if you're on a 32% tax bracket and you're paying a loan of about 3% interest, the pre-tax equivalent needs to be about 4.4%. So once we know that figure, once we know the figure that we have to pay off our home loan and the pre-tax equivalent rate, we can compare it to other options. So in this case, is my bank account going to give me more than 4.5% interest? No, it's not. And either's high yield savings account, either's term deposits. So for a lot of investments in your own name, paying off your debt is the most attractive option. And this is where banks can offer things like offset accounts or redraw facilities that are effectively acting as a savings account, but you've got access to those funds, but whilst they're in those accounts, they're reducing the amount of interest you're being charged, usually at that equivalent rate. So having money in an offset account on a home loan is like having a bank account, but in this case, you're earning around 4.5% interest. Let's have a think about other interests though. So if you've taken out a personal loan, might be for a holiday or for a car or for some furniture around the house, a typical personal loan at the moment rate is around 7%. Again, if you're on 30% tax bracket, the pre-tax equivalent rate of that's around 10%. And then if you're looking at a credit card at the moment, so if you've got a credit card debt where you're currently paying off less than the full amount and you're getting charged an interest on that, the average interest rate at the moment is around 20%. The pre-tax equivalent rate on that is around 30% interest. So in those cases, when interest rates are higher, then it becomes much more attractive to pay off the loan. So at the moment, with home loans being relatively low, yes, we can get more return than the equivalent rate of 4 or 5% that it may be on a home loan. But when it comes to personal loans or credit cards, it's difficult to get higher pre-tax rate of returns in your own name than 10% or 30% on a credit card without taking significant amounts of risk. So some of the things we need to consider when we're looking at two of our wealth creation options of savings in our own name and debt reduction are minimise the use of low interest rate accounts, particularly if you've got that debt. If the home loan rate is higher on a pre-tax equivalent rate than your accounts are, then pay off that home loan. But make sure you're considering access to the funds. Again, one of the reasons why we want money in our own name is for access. So if you're paying extra off your loan, talk to your bank, make sure you've got availability of those funds. Consider the risk as well. When I'm paying $1 off my mortgage, in that example that we talked about, it's like I've earned equivalent of 4.4% interest risk-free, which isn't too bad in this environment. If someone offers a risk-free investment of around 4.5% at the moment, it's a reasonable option. So consider the risk you're taking compared to paying off that debt. The examples I've used today on the loans are assuming there's no tax deduction available on those loans. So if you've got a loan that's tax deductible, like that on an investment property, it changes the equation. So you need to consider that when considering your alternatives. Keep an eye out for our other episodes where we cover superannuation and gearing as our final two concepts of wealth creation. Thank you and goodbye.